Joining us right now to talk about it is Stephen Parker. He is the co-head of global investment strategy at JPMorgan Private Bank. And Stephen, we're sitting right at market highs for the major averages. And yet, every time there's a little bit of a concern about what might be happening with technology, you do see the pullbacks kind of quickly. Again, we are not talking about being far from all-time highs for any of these major averages, but what did you think of the action yesterday in the software market?
Yeah, I actually think what we're seeing in markets so far this year is very healthy. I think a lot of people would have been skeptical at the idea that we would be sitting near all-time highs, despite the fact that the tech sector is the worst performing sector in the S&P and has fallen more than everyone else. This broadening story that we are seeing is really reflective of the anxiety that investors have had over the last couple of years. It's been all tech all the time. People have been worried about concentration risk. Now we're seeing a rotation. It's about a broadening of the recovery story. Cyclicals are picking up the slack. And it's not just the AI infrastructure plays and the hyperscalers that are driving markets higher. It's actually the AI beneficiaries. That's going to cause some disruptions, particularly in sectors like software.
So where do you invest at a time like that?
Yeah, I think we still like the tech story. We think we're probably in for a period of consolidation as tech companies continue to grow into these earnings. But there's also opportunities more broadly, whether you're thinking about cyclical opportunities in the U.S. We really like the industrial story, the power story, but it's also a global story. You know, the leadership that we've seen from non-U.S. markets that really started last year has continued into this year. And if you're looking for opportunities that may not be as specifically focused in technology that are beneficiaries from this global broadening, you know, markets like EM, particularly Asia ex-Japan, we think are going to be big beneficiaries.
Your base case for U.S. equities, looking at the S&P 500, is high single-digit returns. You're thinking 7,200 to 7,400, but your bull market case is 8,000 to 8,200.
Yeah.
What has to happen to differentiate between your base case and your bull case?
Yeah, so the base case is really based solely on earnings growth. We think we're going to see low double-digit earnings growth, and we actually think you see multiples come in a little bit given the starting point. To get to that bull case, we need a couple of things. We need this broadening cyclical recovery to happen. We need to see earnings growth not just out of the tech sector, but other parts of the economy. We need to see some of the productivity benefits from AI turn from talk into action when it comes to companies. And we think if you get that, you know, investors will be willing to pay that higher multiple. You get potentially a little bit of multiple expansion on top of mid-teens type of earnings growth. That's what gets us to that bull case scenario.
We have seen some wobbles in other areas of the markets, too, particularly what we've seen with gold and silver. Gold is a conviction buy for you right now. Even though it's trading back above $5,000 an ounce, you think it could go above $6,000 an ounce?
We do. We've been bullish on gold for the last 18 months or so. It's been a great call for our clients. The idea behind the gold trade was really one around diversification. Diversification of dollar exposure for central banks, for institutional investors, for individuals. We've seen that story play out, and we think that demand is going to remain strong. Then on top of that, you get the diversification benefits against heightened geopolitical concerns, inflation. Gold checks a lot of boxes, and we think that rotation and that demand is going to stay robust.
Does silver make sense to you? It's up 170% over the last year.
Yeah, we're more cautious on silver. Silver feels like it's the more speculative way that investors are trying to play the precious metal trade. Silver also has a challenge because, you know, one, it's a smaller market, so it's hard to move in size for these central bank buyers. Two, it has a lot of industrial uses, and when the price of silver goes up, you know, the solar panel producers are going to start asking questions around whether there's alternatives. And so, you know, we're more cautious on silver. We prefer gold as the core diversifier and see upside there.
There has been a bit of a sell America trade over the last month or so. You don't buy into that. You don't think that's here to stay? No,
we don't think it's necessarily a sell America as much as it is a buy less America. You know, after the last decade plus of American exceptionalism in markets, you've seen U.S. stocks go from 45% of the global equity market to 70%. Investors are very long dollars. And in a world where policy uncertainty in the U.S. is increasing, we started seeing it last year. We think this is a rational rebalancing. But ultimately, we think the fundamentals, the growth drivers, inflation is under control here. And we think the dollar is ultimately going to end up stabilizing and flows will come back to the U.S.
Do you have a bear case in the markets? I mean, because your bull case is pretty aggressive.
Yeah. The bear case, you know, the easiest way to get to a bear case is if something stumbles in the economy and we see a recession. Traditionally, that's going to translate into something like a 20% drawdown in equity markets, we see that as a very low probability event. What we do expect is that there's going to be volatility. When you have a starting point where valuations are elevated, we've seen it in some of the tech reports, companies that are beating are still seeing their stocks sell off.
With AMD.
So I think the bigger risk is potentially just expectations being too high and some time needed for markets to grow into those expectations.